Good morning, everybody, and welcome to the second in this series of webinars on earning the illiquidity premium. What we've aimed to look at here is the opportunities that arise in real assets, and today we're going to be looking at private markets. I'm delighted to be joined by Adam Myers again as the moderator, and I'll leave it to Adam to introduce our panelists for the day. But before I hand over to Adam, let me just say a little about some of the upcoming events which we have from IMAP. Tomorrow we'll be rounding off this webinar series by drawing together the threads of incorporating less liquid investments, illiquid investments, into portfolios, which might be operated as either managed accounts or just under advice. And we'll be joined by Graham Bibby from Partners Wealth and by Rebecca Jakes from Mercer to talk with Adam about the issues they think about in building portfolios. Later in the year, we'll be holding a number of events to wrap up 2024. Next Tuesday, we'll be joined by Dr. Tim Edwards, who's the Global Head of Index Strategy from S&P, who'll be talking to us about what market data tells us about the opportunities in this macro environment. For those of you who are going to the FAAA Congress, IMAP is once again one of the largest exhibitors, if not the largest exhibitor, and we'll be drawing together 10 managed account providers in the managed account zone. So if thinking about creating a managed account program is something that's of interest to you, important to you, or if you'd like to talk to some of Australia's leading portfolio managers and managed account providers, the FAAA is an opportunity to do that. On the 4th of December, with Lonsec, with Nathan Lim from Lonsec, we'll be joined by Monik Kotecha from InSync, and Chad Heitzman from GlobalX to talk about the Asian opportunities, the role that Asia may play in portfolio construction. Then in February, when we all come back relieved from Christmas, an opportunity to participate in the IMAP Award Winners Showcase, where we showcase what it takes to be a leading portfolio manager in the IMAP Awards presentations. And then in March, the IMAP Portfolio Management Conference in both Sydney and Melbourne. I needn't tell you how to ask a question, but we do encourage questions, and I was delighted to see how many questions we did in fact receive during the course of yesterday's session when we focused on real assets. So I'd encourage you to ask questions of today's session. So now it's my pleasure to hand over to Adam Myers to introduce today's panelists. Thanks very much, Adam.
Hi, everybody, and welcome back. Toby, just before we get started, Hagai is struggling to get in, so he has joined on the participant link as opposed to the panelist link. If you could upgrade that link from Koda Meeting Room 4, that would be great. Now that we have got through that little bit of admin. If you joined us yesterday, welcome back. If you didn't, I would urge you to listen to that recording because it really was an excellent conversation about the opportunity, the current opportunity in real assets. Today, for part 2, we are going to be discussing private assets, and joining me for this conversation is Fred Pollock. He's the Chief Investment Officer at GCM Grosvenor, which is one of the And there we are. I see Hagai is also joining. So firstly, let me finish with Fred. He is the Chief Investment Officer at GCM Grosvenor, which is one of the world's largest and most diversified independent alternative asset managers in the world. Fred is also the portfolio manager of the Pengana Private Equity Trust, which trades on the ASX under the ticker PE1. Just joined us now is Hagai Netzer. Hagai is a partner at Koda Capital. He's the head of research and manages Koda's core and opportunistic portfolios. He was previously the CIO of a multifamily office in Israel, and he also managed a multi-manager private credit fund. And lastly, we have Nehemiah. Nehemiah works with me at Pengana. He is the managing director and the CEO of Pengana Credit. So he oversees our range of products in the space, which includes a wholesale fund, a listed trust, which trades on the ASX, the ticker's PCX, and Term Plus, which provides a variety of fixed term exposures. So, Hagai, I'll start with you. A key question to set up the rest of the conversation: why private markets, and what do they add from a portfolio construction perspective?
Yes, thank you, Adam. I think, well, private markets has really been a trend, I want to say, over the past decade or decade and a half in most private wealth portfolios, really globally. And I think that the main reason is really the diversification benefits that an investor gets, right? So just by trying to put together a well-diversified portfolio, if you look at the private market space, it's actually significantly bigger than the listed markets, space, right? So private markets, I think I saw a data item the other day where there are about 50 or 55,000 globally listed companies, while there are about 350 million private companies globally. So just accessing that opportunity set, I think, allows for greater diversification and actually greater outcomes for investors.
Okay, so greater opportunity set, greater diversification. My next question relates to returns. Have private markets outperformed listed markets, and over the longer term, should we expect this to persist? I think it might actually be a different answer for private equity and private credit. So Nehemiah, maybe I'll start with you there, and then you can hand over to Fred.
Yeah, sure. And excuse me. Thanks everyone for joining. It's a pleasure to be part of this conversation. I think as it relates to private credit, and I'm sure probably many of you would have heard and seen information on this, which is from the private credit perspective. There's two things really. Firstly, if you look at over time the comparison of private credit assets relative to whether it be traded equity, traded investment grade, high yield, or leveraged loans, which are basically traded bank syndicated loans, over most periods of time, most durations, you'll find that the risk vol trade-off that you get with private credit, meaning the annualized return against the annualized volatility as managed by the standard deviation of changes over time, that in private credit, what you get is, as a result, a return profile that's about 1.5 or more times greater than the annualized volatility relative to those asset classes, which is what I think is one of the big attractions of private credit as an asset class. But the second thing that I would say that I think is really critical is capturing that premium, if you will, is really highly dependent on where you play. And what I mean by that is, where you can capture the premium is where you have the structural dynamic that's occurring in the U.S. and Europe that's driven by changes in bank regulatory capital requirements. And in that context, effectively what's happened with regulators is the increasing the amount of capital that banks have to hold in various parts of their portfolios to kind of disincent banks from taking at call deposits and putting them into long duration assets. And so as a result of that, you have a clear structural gap that's emerged in kind of mid-market corporate space in the U.S., and you also see it in a number of asset portfolios on bank balance sheets. I only raise that because the importance of where you participate in private credit is critical, because where you want to be is where there are no alternatives for borrowers to access credit outside of private credit. You don't want them to be able to arbitrage a private credit manager with liquid credit markets. And so if you kind of follow that, I'd say, it's a great way of capturing that dynamic I spoke about a second ago.
Great.
Maybe I was going to say, maybe I'll pick up on the second piece, which is sort of private equity and the return story and its persistence. So maybe I'm going to answer it two different ways. So the first, if you looked at data over any period of time, 10 years, 20 years, 30 years, sort of the private equity industry in terms of robust scale and data really sort of started in the late 70s, but really the data started in the 80s. Over any of those time periods, you'd see the private equity outperform the public markets kind of over those time periods from the top down. But I think the more important thing when you try and discuss, well, is that persistent? Is it simply the way the data is being cut? Like that's an accusation often kind of thrown at the private equity industry. They're just cutting the data. So then you have to look at the bottoms up, sort of like what's driving the differential in return. And there, I think it has more explanatory power, which is if you broke up, for example, and instead of comparing private equity to all public companies, you instead compared private equity to controlled public companies, the gap would narrow a lot. Meaning the idea of control, having stewardship and having appropriate control of a company as opposed to sort of no one really in control except for the management of the company in a dispersed sense in the public markets, adds value to companies. And so that's part of the reason that private equity actually does better. And that's where most of the controlled companies live. But it would also make an argument that if you invest in public companies, you'd rather have a controlled public company than non-controlled public companies. The second piece, which is real, is the use of leverage. And I think some people would look at that and say, well, is the leverage higher in private equity than the public market? And not really, if you break it down by type of company. It's really about getting companies to have the appropriate amount of leverage. And there, it's really about management incentives. So if you don't appropriately align management in terms of risk and reward, with appropriate monetary packages, they will not necessarily select for the appropriate amount of leverage for their company, meaning sometimes they will over-lever a company, sometimes they will under-lever a company. And so there's actually a value driver there in terms of kind of appropriately kind of aligning the incentives. It's the explanation for why there's a differential in return. It's not about the sort of the form of ownership. I could take a private company and take it public. It's the same company the next day. I could take a public company and take it private. It's the same company the next day. It's these governance or stewardship concepts that are kind of driving value over time, and they tend to drive the difference in value over that period of time. And that's what you would see in terms of returns. It's where kind of the extra 500 basis points of return is coming from, is that kind of control governance, sculpting of the economic return and aligning incentives and management, with the shareholders in a slightly tighter frame than the public markets. I often get that, not to say that there aren't great public companies. There are public companies that are sort of at such a scale, for example, that they have to be public. But if you looked at the mass of kind of companies that could be in either form, the private or controlled form has tended to outperform a public form with a non-controlled shareholder.
So Fred, what level of shareholding would typically satisfy that requirement for control?
Yeah, I mean, it really depends. So if you go into the public markets, there's different regulators around the world who have different definitions of this. Some of the lowest 20%. And that's actually true. Like if you own 20% of a very distributed shareholder base, you might actually control that company. Typically when we're talking about private equity, you're talking about 100%, right? In almost every case, the control shareholder in that case would own 100% of the company and have full and total alignment, except maybe management would own a piece. And there would be a sort of a package of economics associated with that to align the management with the company as well. Sometimes it's more than one private equity company owning at the same time. But you're really talking about substantial economic ownership, kind of the downside and the upside over that period of time. The other thing that I think really sharpens the mind, if I buy a share of a stock, I could sell it the next day, I could change my mind, I could do all sorts of things. When a private equity sponsor buys a company, they are stuck with it for good or bad. for a long period of time. And they need someone else to do kind of a very considered analysis, whether taking it public or selling it to another private holder. I think it tends to sharpen the mind and the judgments. I'm not saying that they're always better, but they're more considered, I think, rather than someone kind of incrementally purchasing a few shares of something on the public markets. And so you don't end up with the same volatility in price. You end up with a kind of a more established, stable price when you're talking about whole of company or most of company transactions versus sort of very small fractional interest in a public company.
That makes sense. I can certainly think of a few examples on the ASX where we've got these high levels, particularly of family control, and these companies have outperformed. Coming back to a point you made at the beginning, Hagai, about volatility, does the lower volatility in private markets disguise the true level of risk?
I'd say yes, but to a very limited extent. I think to a much lower extent than what most would think. I mean, valuations. I mean, if you think about valuations just generally, right? They're always a point of time estimate for the true economic value of any asset, really, right? So even if you look at private market, at listed markets, right? I mean, listed markets valuations vary all the time, right? You could buy a stock and it can shoot up or down 30% the next day. So they are a shot in the dark to an extent, and I would say probably at any point of time. When it comes to private markets valuations, I'd say they are as good as the set of assumptions behind them, right? So it's interesting because whenever these valuations are being put together on a let's say a private equity fund's capital account statement or balance sheet for that matter, they typically go through quite a rigorous process to put them forward, right? You would have, in most cases, you want to look for third-party valuations and valuators to run through those exercises, and clearly a robust set of assumptions behind them. So I'd say, private markets valuations are probably as good as listed markets valuations. And I'd say that's probably the main point that I make. The second one is probably just around the path to realization, right? So again, when an investor buys a listed stock, the optionality to sell it a minute after is typically there, right? With private markets, again, like was mentioned here, that option is not always on the table, and so that actually impacts the valuation methodology for a private markets asset, right? So most companies would be valued through, using a 3, 5, or 7 year forward-looking kind of model that has a lot of assumptions in there that in most cases would actually be quite reasonable, right? That the company would continue to operate, the company would reflect some sort of a growth rate where it's or would experience some sort of a growth rate to its revenue. So in most cases, that's what the investor or the holder of that private equity experiences, right? They hold it for a few years. They either benefit from those revenues, hopefully translating into earnings, or they sell it to the next investor with the same kind of thesis, right? So as long as there's no strategic or dramatic shift in the market, for that matter, or within the company, I'd say that private markets valuations are actually quite valid. Which means that the volatility that they might, disguise is actually not that material.
Okay, makes sense. So, Fred, Hagai has spoken quite a lot about valuations then being the cornerstay of sort of investor protections. But in Australia, unfortunately, investors have been exposed to a few dodgy practices in the past. I'm not going to mention any names here. But can you just touch on what best practice really looks like, and if there are any safeguards that investors should look out for?
Yeah, I mean, there's kind of probably two sets of these. So the first, the valuation methodologies themselves, almost everyone uses third-party valuation checks in their process, as opposed to just doing everything themselves. So meaning they are going through a process of internally creating a model and valuing. They bought on that basis, they would sell on that basis. So these are real things they believe in. They're not going to sort of just make up kind of, and then they would go and pursue third-party valuation confirmation as well from reputable companies. And then they would try and compare and see whether their value is falling into the range of the reputable third-party provider of the valuation check. That does not mean that you can't get errors, but it does mean that you at least have some consistency across the industry, right? Because the third-party valuer, who there are only a few firms, they typically are doing this for a lot of different firms. They're using similar kind of metrics and numbers. You're not going to have one person assuming, you know, kind of a growth rate of US GDP of 5%, and another person assuming 2%, and that these companies that are otherwise identical, one has a huge value. You're just not going to have that. And so it sort of helps create some homogeneity in terms of the way that people approach and value them. I think the second set of things that are very, very important, it's just not the way the private equity industry is remunerated. And I think that is important. So when a private equity sponsor goes and buys a company, they form a fund, you know, to do that. The fees are typically charged on the amount of capital that's committed to the fund, not to the NAV. So the idea of sort of on paper marking assets to a place that maybe is unrealistic, I think that's what people are primarily concerned with, is the overvaluation of those assets. They're not going to collect extra management fees as a result of that. Their performance fees are paid on realization, right? Like typically it's a European waterfall. They have to return all the money plus a certain amount of return on that money. Then they start collecting and sharing it with a full clawback based on the realization of the entire fund. So there's no real ability for those individual valuations to game. I think you could make an argument that the only incentive private equity really has to sort of mismark the assets is if they're out in the market trying to raise other funds, but that catches up with them, right? So if you looked at the industry and you sort of said someone was, you know, they had their first fund and they just overmarked everything and then they raise a second fund, it's just going to catch up with you, and reputations are long and lives are long in the private equity industry. And, you know, people evaluate you on that basis in terms of your integrity and other things. And so I think the kind of the ecosystem for talent would weed that out pretty significantly in terms of where people would provide, you know, kind of incentives otherwise. So I think it's both things. You have a nice, robust process. It's governed, obviously, in a lot of cases, like in the US, the SEC would govern this process, and a lot of tight manners, different regulatory bodies govern it. People, I think, respect it. It's also governed by different associations like ILPA and other sort of governing agents around the funds themselves. But then you have these sort of real world truths, which are investors are not paying and do not want to pay people based on things that are sort of not real and realized essentially over a long period of time. And so I think those two things come together to keep the process reasonably robust. And if you see the other thing I'll tell you, I think I could make a pretty good argument based on Hagai's comments too, that the industry smooths, it doesn't really cheat otherwise. So meaning, what do I mean by the smoothing? They're slow to mark things down, they're slow to mark things up. It's sort of reciprocal, and it has a smoothing effect. If you ran our private equity return streams through, you know, some of the indicators we use through detecting in hedge funds fraud, it would set off alarm bells, because people would look at it versus the market indicators and say, hey, this is too smooth. The return profile is too smooth. There's something going on. And it is a feature of private equity. It's not a bug. It's a feature of private credit. It's not a bug. It's a feature of all of these assets. That is in fact what the industry, I think, wants, which is people not to mark the assets up too quickly and not to mark the assets down too quickly, and be more in line with sort of a smooth long time realization path, you know, for the overall asset, because it's not really in anyone's interest and they're not transacting or being paid on these sort of interim marks.
Incentives matter, and the last thing a private equity manager wants to do is have a realization at a price lower than where the asset is marked. Now I'm going to try, and we've got quite a few questions coming in, so great, keep those coming. I'm going to try and blend them in with the questions that I have prepared. So we've got a question here from an anonymous attendee who is interested, Fred, about the extent to which that premium, the private market premium, would be competed away by PE managers.
Yeah, I mean, the idea of an illiquidity premium or a risk premia, we're going to talk about two different things. The illiquidity premium is like a hotly debated topic. I could find you 50 academic papers that would try and prove that it exists, and I would find you 50 academic papers that would try and prove that it doesn't exist. And it's not kind of settled literature is probably what I'd say. My experience, it does exist. Because people do want to be paid for what Hagai was talking about, which is kind of the lack of optionality, like meaning it goes the other way too. If I had a bunch of short-term options, it has value, and I lose those short-term options. And so I think there is kind of an argument for it. Typically ranges 50 to 150 basis points over time. The modern status of that is probably more like 50 bips, not 150 bips. And so whoever's asking the question is kind of attuned on that one, which is I do think the proliferation of funds in the private context have kind of worn down the illiquidity premium correctly, like as a matter of formation of capital and intermediation. The risk premium never goes away. So the risk premium is being paid for the kind of the utility or the function of the asset class itself, whether that be private credit or venture capital or private equity or what have you. That risk premium is what you're paying for in the asset class. You know, it's sort of the risk return you're expecting from, you know, kind of that stream. I don't really see, I mean, that doesn't dissipate. That's sort of like the value of the form of economic ownership in that, you know, asset class. It is the job, obviously, of the managers to also try and produce alpha on top of that. And, you know, that alpha is the part that I think can get competed away depending upon the prevalence of capital. You know, if the opportunity set's a certain size and there's twice as much capital formed to attack it, the alpha will dissipate, but the risk premium will not typically.
Makes sense. Nehemiah, private credit has really emerged as an asset class over the last 10 to 15 years. Has the increase in activity in the space created more competition that you see in terms of the pricing that we are seeing, i.e., are we accepting lower prices for the transactions that these managers are taking at this point?
Yes. The short answer is it kind of depends where you play, you know, where you invest. And so what I mean by that is if you look at the mid-market corporate space, which is where you'd see the predominance of funds, you know, in Australia, global funds in Australia sort of raising money, and same in US and Europe on the direct lending side. What you'll find is, you know, there's very wide definitions of what mid-market means, you know, whether it's companies that make 10 million bucks of EBITDA at the lower, or say 250 to 300 million in the upper. Really, I think where you see different pricing dynamics based on supply and demand are really in what they call upper mid-market. So, and really that is where companies that are large enough where it actually makes sense for them to access traded credit markets, and in particular the bank syndicated loan market, because it's there that you know, anybody who's watched spreads over the last couple of years, you'll see in 2022 those markets were shut. Private credit came in and got crazy spreads to provide liquidity to companies that needed it. Today, you know, you're down 250 up to 300 basis points depending on where that is. And so in syndicated loan markets, not only do you have a pricing advantage, you also have a risk advantage, meaning if you're a borrower, you have less restrictions put on you in terms of leverage and other things. And the way that you're actively managed, well, you're not actively managed. You put a covenant certificate out to market every quarter or whenever you're required to, which is very different to core and lower mid-market, where in those spaces in private credit, if a company doesn't really have that ability to get better risk terms and better pricing terms in liquid markets, then it's a question of what private credit manager will provide you with that. Now, in that space, what you'll find is the spreads have been way more stable. They've come off a bit, but if you look over sort of 25 years, you know, the spread range is between 500 and 600 basis points very consistently in the illiquid part of the mid-market. And that really hasn't changed much. And what we found with managers is, you know, long-standing managers that have very strong relationships and competitive advantages in origination, they have scale in the size of their funds so they can more quickly deliver solutions to people. They don't compromise, and they haven't been really having to compromise on risk terms, and they've really only had to compromise a bit on spread, but they're still well within that, you know, historical range. So that's why I say it really depends on where you play. The final thing that I would say is, you know, when I said before, and I say it to whenever I talk to people, you really want to be clear on where the private credit manager is pointing their business. And what I mean by that is you want to see a predominance of their capital being deployed where the structural gap exists. And that gap is not shrinking, that gap is actually growing. And so forgetting about bank withdrawal, there's also a lot of private equity dry powder that has to be put to use, for which they would use private credit managers to actually fund. So the supply demand dynamics that kind of sit within that mid-market area, are quite structural in nature. And that actually is what underpins, the spread premium that you get. And the final thing about this is, and it goes to, I think, a lot of Fred's comments. If you go back to the beginning of this conversation and you see, well, how do private equity managers actually manage these businesses and what are their incentives, et cetera, you find the same in private credit, meaning, the governance, the information rights, the control rights, the active monitoring, because you're holding these things to maturity without liquidity, is what actually helps to withstand and maintain the kind of spreads that you see in that core to lower mid-market.
And so you've spoken quite broadly here, but do these factors differ across regions? Are there other jurisdictional considerations that
Yes.
investors should have in mind?
Yes, absolutely. I'd say you see a very big difference, say, structurally, in the structural dynamics between us. So first of all, Australia and Europe and the US, very similar dynamics. Okay, you tend to see in Europe in mid-market, you'll see a spread premium there relative to the US, and that's just more a reflection of the market structure, where there's I think there's fewer larger managers that are pan-European. Okay, and it's very hard to build a pan-European platform from scratch these days. And so you'll tend to see it's more concentrated in Europe. The dynamics around fundraising are similar, but it's more concentrated. And I'd say with less structural competition, you actually have a slightly better spread. Okay. But if you then look at the difference between US and Europe and Australia, so we call global US and Europe. So if I was to say in Australia, it's vastly different. And there's a couple of key dynamics there. The first is that in Australia, the banking system banks 90% of all credit. Okay, and 10% is done by a private credit manager. In the US and Europe, you'll find it's flipped because of the regulatory reasons and structural reasons I talked about earlier. And as a result of that, what ends up happening in our market in Australia is that private credit plays a very important role where banks don't have risk appetite. Okay, so you'll find banks do not lend, broadly speaking, into commercial property, which is why the vast majority of private credit in Australia is in commercial property. Secondly, banks don't lend into mezzanine positions in structured credit vehicles or asset-backed vehicles. So you'll find that a lot of non-bank lenders will have a senior AAA piece in their funding structures that are bank loans, and the balance of the subordinate and the capital that sits underneath it outside of equity is in the private credit sector. And then finally, the third piece that you see in Australia is in private credit is a lot of syndicated loans for big, very large leveraged buyout deals. Because once again, that's not where banks like to play. And the reason they're syndicated is so managers can try to disperse the highly levered risk. So if you look at the risk return trade-off, on the final piece is you don't really get much diversification here. It's very hard outside of asset-backed securities. It's very hard to get wide diversification within a single portfolio. Okay. And so I would say that, when you're looking in Australia at private credit, you really got to do two things. You got to say, am I happy to take the Australian macro risk because it's all Australian macro risk? And then within that context, where do you want to play on risk reward? And I think the manager selection there is critically important. The only other thing I'd want to mention in relation to Australia versus the rest of the globe is kind of directionally, where it's headed. And within that context, I think you'll find that you'll see a lot of press here on sort of ASIC review of the sector, which is actually really going to kind of cover off on what I would say are the global practices, the independent valuations, the governance, the track record and history through cycle of delivery, whether it be private equity or private credit, very, very long-standing and tested in the US and Europe, and it hasn't really been tested here. And so I think, in the next sort of 12 to 24 months, you'll start to see, who are the managers that actually have that transparency, that governance, the independent valuation processes, etc., relative to kind of what you see happening in the US and Europe. And I think there's a maturity that that kind of needs to come to some parts of the market here that'll be great for investors, but will take time to kind of walk through.
Makes sense. So basically, we know that regulators are attracted to growing markets, so the ASIC attention isn't surprising. With that in mind, Hagai, do you see any sort of regulatory challenges on the horizon?
I don't think that is going to be hit with a regulatory wave when it comes to private debt. I think we need to remember that from a regulator's perspective, private lenders really solve for a very significant this what used to be a challenge in the system of banks just over leveraging their balance sheets, right? So every dollar effectively that migrates from the banking system into the private debt system implies a significant drop in the overall systemic leverage, right? Because banks again are so levered. And the average bank would be 5, 6, sometimes 10 times leverage, right? Again, for every dollar of credit migrating to a private lender, so private lenders are actually running at negative leverage ratios, right? They have cash on their balance sheets. They go and then they park those the borrowers park the credit proceeds or the loan proceeds on banks cash accounts. Banks cannot actually go and on-lend those cash accounts at the same leverage ratios as the regulatory, as the other layers in their capital structure. So from a regulator's perspective, private debt is actually is good news when trying to manage systemic risk, right? I think when it comes to, if one area of private debt might be in a regulated scope, it might be just retail investors getting into that space. And then I would say, as long as there's a professional investment advice involved, it's probably one of the, it's a low to medium risk type asset. So I wouldn't expect any significant regulatory scrutiny around private debt anytime soon.
Makes sense. I just want to clarify because we've got a question here. And Nehemiah, you've definitely referred to mid-market. Fred, I expect you may have as well, since you have a sort of a sweet spot of focus on mid-market. Do you both just want to clarify what you mean when you refer to mid-market in your respective areas?
Nehemiah, you get to go first because then I can just agree with you because I'm pretty sure everything.
Yes, I think I mentioned before, it's sort of it's a wide space, but basically it's companies, the way the definition is really companies that have EBITDA at a minimum of around 10 million and going up to 250, 300 million, right? And then within that you have upper, which is at 250 to 300 million. And in the credit world, it's really what are the companies that can access traded credit markets? So that might go as low as 100 million. Okay, but it depends. The core of it is really 75 to 150, or say 50 to 150 is kind of the core mid-market, and then anything below 50 to kind of 10 million is lower mid-market in the credit.
I'm thinking you can tighten that up a bit.
Yeah.
Well, if you go to just all you really need to do is take his numbers and multiply by 10. So I mean that's essentially what we're talking about in terms of enterprise value. So it's sort of the he's saying the smallest banked company in private equity, sort of $100 to $500 million company. It's probably right. They'd be very small, at least in the US and some other places. I think people would think of lower middle market today as sort of roughly $500 million to $750 million companies, maybe a little bit smaller than that, depending on the size of the market. The middle market is like 500 million to 1.5 or 2 billion. Then you get over kind of 2.5 billion. You're talking about pretty big companies, which that's where you go to Nehemiah's kind of 200 million, times 10 basically in terms of the size of the company. Obviously a little bit different than Australia where you have listed companies at kind of smaller size. You don't really have a lot of that in the US and Europe anymore. The regulatory costs of being public are pretty high. And so you don't tend to have a lot of sort of $500 million companies or anything listed. Almost all of that lives in the private markets.
Right, thank you. I think we've sort of covered off those preliminary sections quite thoroughly now. So turning to technology and innovation, Fred, interested in your perspective on if AI and data analytics are making us better and or more efficient investors.
Yeah, I don't know that I don't, you know, it's weird. It depends what you're trying to do. If you're trying to produce alpha or more, it's really not going to be better because everyone's doing it. So what will really happen, it's sort of a, I refer to this phenomenon as sort of standing on tiptoes. It's like if you go to the ball game and someone stands up and then the person behind them has to stand up, everybody has to stand up. That is essentially what's happening with AI and data and analytics and investing, which is, I think it's sort of just table stakes for the whole industry that you have to figure out how to integrate it into your process and get better. It's early days. It's sort of, it's not like you look at any one space, hedge funds or private markets, you know, whether private equity, venture, private credit, et cetera. And there's someone who you look at and say, wow, they're doing something brilliant with AI that is just completely different than what everyone else is doing. Even quant managers, you know, who they live and breathe on the idea of kind of integrating data into it. It's, everyone's doing roughly the same thing with these technologies, but I think there's a sense that if you aren't on the path of adopting some of those technologies in what you're doing, you get left behind. Therefore, people are spending, you know, time, resources, capital trying to figure it out. The markets should just get more efficient, right? It's like what should have basically happened is that the end result of all this is sort of when you net out the costs of doing it, the return, you know, should be the same. And the markets are just a little bit more efficient, meaning they're better at pricing, and there really isn't any alpha caused by, would be my guess, which is probably a depressing statement for everybody who lives in the alts environment, but I think that's the truth. We're all going to do a lot of work just to maintain your relative position if everybody does it well, and then maybe somebody won't, and you can, you know, move up a little bit in the pack in terms of return, you know, kind of on that basis. But no, it's the most money is being made in AI and data analytics by, you know, kind of selling the picks and shovels, right? So it's sort of if you really looked in the marketplace, the platforms like Microsoft and others who own parts of OpenAI, and then some of their cloud technology, and then folks like NVIDIA and others selling chips, they're the ones really making money off of it right now, not the people in kind of, and certainly in finance, kind of implementing those technologies. I think everyone's just doing it, and it's, you know, I don't expect their return on equity to increase or decrease as a result of it. I think they're all just going to spend money, and it's going to be part of the business.
Makes sense. Fred, I'll stick with you for the next question, because you allocate to both private equity and private credit on behalf of different clients. Do you look for different attributes in PE managers when compared to what you look for in private credit managers?
Again, yes, for sure. So if you think about, it's entirely like their perspective is different, right? A great credit investor, generally speaking, looks outside and sees the clouds and, you know, thinks I should get an umbrella and I should, you know, be ready for that. And I wonder what's going on. And a great equity investor, generally speaking, you know, kind of sees that and they're relatively hopeful, and they have maybe a plan of action if it goes that way, but they see upside, right? It's like they're almost spiritually, they're different animals, right? In terms of where they are in the capital structure. When you find a private equity manager who's good, what do they really have? They have domain expertise. So they know some area or some niche typically today that they just know better than others. They know all of the management teams in that area. They know all the assets. They have a plan of action to take cash flows from an enterprise and increase those cash flows. Right? It's not about anything else, really. I mean, that's how almost all of the value is going to be produced. You can get lucky and have interest rates decline. You could get unlucky and have interest rates or your cost of capital go up. But in terms of what they can really control, it's sort of how do I manage the company? How do I implement a business strategy to kind of grow? So you're looking for that. You're really looking for business people who know how to kind of make the cash flows and operations of a company kind of increase in value over time, or, you know, strategically enter and exit at different time periods that are good. You care about their portfolio construction and their risk management, but people have a huge tolerance in private equity for what is, I think we would consider pretty poor risk management in a lot of ways. Meaning, you know, if all of us had a portfolio with 10 things in it, 10 companies, particularly levered equities, I don't think you'd feel that excited about that. And that is your average private equity fund, right? In terms of the risk management and the kind of expertise. When you get to the credit space, it's just completely different. You're expecting someone who knows the companies, but you're not expecting them to alter its business profile. They're not in control of that, but they know everything that can go wrong. They know all of the different pieces. They know the players really well, right? So they know who they're lending to. If you think of all the kind of the parts of credit, the people as well as the assets. The really great credit managers have a focus that is mostly on the downside. It's been traditionally, I would say, that the time period you expect them to have been in operation or their knowledge from their career is longer. You have a kind of the idea of gray hair in credit space, I think, is even more appreciated than in the private equity space. I think the credit managers are typically better portfolio managers than the equity managers because they have negative convexity in their trades, right? They don't have a lot of upside. In most cases, maybe they have a warrant or something else, but they don't really traditionally have a ton of upside in what they're doing. Lots of downside. They have a portfolio, therefore, is grounded more in math, kind of numeracy, diversification, better protection. So when you look at the two, it's almost like different profiles of people. And they all need to know the businesses and the economy and all these things. Like the expectations and quality of the people is very high, kind of on average, but their focus and what they can do and how they drive it is kind of different. And, each of them, the other thing I think it's undersold. People would sometimes say, wow, the credit people, the equity people are relationship people, the credit, but they're all relationship people because the entire ecosystem is about your kind of relationships and how you function with each other. Everybody runs into each other for basically their entire careers, and kind of their reputation and how they behave in different markets and those kinds of things are kind of very, very important. I would tell you the other thing, credit, if you have an expectation that they know better how to deal with adversity. So the equity folks lose the keys, right? When they really mess up a company and things get really bad, they lose the keys, and then the credit folks have to take over and deal with it. And so there's a whole aspect of kind of the workout of difficult situations that only credit people really know, and they know the trials and tribulations of that. And so that's another focus area when you look at them. So different skills, but they're both, it's very complementary actually, in terms of if you think about what they all know and how they work.
Different skills and maybe even different personality traits.
There's definitely a thing. I mean, the most significant, if you talk about distressed credit investors, those are a totally different animal than everybody else. They're a different animal than the equity investors and the credit investors.
Fair enough. And Hagai, when you are looking at constructing portfolios for your clients, can you talk sort of through some of your manager considerations when you're selecting managers?
Yeah, 100%. I'd say, first of all, there are a few rules that apply to both, to both managers, both strategies when it comes to private equity and private debt. I'd say, diversification is probably the number one or top 5 considerations for us when looking at managers, right, and strategies. I think it is especially important in private debt, right, just because if you choose the best bond or you underwrite the best loan out there, you don't expect to make 4 or 6 times your money, unlike in private equity, right? So, no, that's not all. So I'd say it's especially important in debt just to protect that downside. In private equity, I'd say conviction is important as well. So we're looking for managers with that again, alluding to what Fred mentioned here before. Know their companies inside out, have very bullish and strong views on them, good with, working with management teams. So, when we're sitting in front of managers, it's not just the portfolio or the track record that we, that we try to review or analyze. It's that manager ability to, impact management teams in both good and challenging times. And really, sometimes it's about vision, right? It's about managers understanding the vision and where a company can grow to, even if just by looking at the balance sheet or the income statement doesn't look very very promising in some points of time. So yeah, we are looking for those different attributes in both across the 2 asset classes. What I'll mention additionally is in the private credit space, you make sure we want to make sure that we're investing with managers who've gone through those hard times before, right? So a manager that never experienced defaults is not necessarily a good, a positive for us. We want to invest with managers who've successfully gone through those types of challenges, right? Which interestingly, we're not seeing many of those recently, right? So yeah, so when it comes to private credit, again, managers experiencing workouts, experiencing defaults. During our meetings, during our updates, we would focus, again, exactly like Fred mentioned, anything that could go wrong, right? We couldn't care less about if the company is tripling its earnings, or is or is launching a new product that might accelerate its growth. That's great. We don't necessarily get compensated for that as credit investors, right? Arguably through a compression of the risk premium, which we know is not really a thing in private debt, right? So yeah, we would focus. We would have full on meetings on us asking what could go wrong. Yeah, and with private equity, it's the opposite, I'd say. So yeah, we can talk about some technical ratios, maybe being leverage or historical default rates, recovery rates, etc. But I'd say when it comes to interacting with the managers themselves, these are the areas that we're looking at.
Makes sense. So basically, the bottom line is that manager selection does matter. You're all constructing portfolios at different levels. So I would be interested to understand some of the challenges of implementation. Nehemiah, perhaps you can start and give your perspective.
Yeah, so just to be clear, Adam, when you say implementation, what do you mean?
I mean,
just so I don't go down different rabbit holes, because there's a lot in that question. Okay.
when you are putting a private credit portfolio together, what are the challenges that you could experience, and how do you deal with them?
Yes. So there's kind of two broad thematics here. Number one is the private credit asset class is a liquid asset class. Right? You can't trade in and out of it every day. So as a result of that, and just looking at the construction of portfolios for different types of investors, you have to face into the fact that you got to construct something that has relevance through cycles, right? And so that's why the way we look at that is you have to have wide diversification. You want to get rid of any kind of idiosyncratic risk, which is why we're geographically dispersed. We're multi-manager because we don't want to take single manager risk in credit, kind of follow some of what Hagai said earlier. So, and thirdly, you want to be able to, through different types of cycles, be able to capture relative value opportunities, right, which are more easily captured in liquid markets. So that's kind of the first thing. The second thing is, different investors have different requirements and different needs. Some people just want the income. Some people want to accumulate. Some people want both. And so how do you then construct a portfolio that has some level of liquidity in it for those who want yield and who have shorter time frames for investment versus others who don't mind being locked up to accumulate, right? And so for us, it's a very big liquidity management exercise, and it's a very big exercise in not just choosing the right managers, but also building different liquidity risk reward profiles of the different types of strategies and putting them in different buckets, we call them, in order to satisfy different investor needs. So just one very quick example of what I mean, because that's kind of very abstract, is if you were to look at our listed fund, we've got in our listed fund, we've got 60% of our money in what we call our income bucket, which is senior secured direct lending, and our listed vehicle is really focused on paying out income. And so we have a minimum distribution rate of 7% of our NAV. And really, what that's really doing is leveraging the fact that 6% of our portfolio pays very regular cash yields, which fund that. Right. The other side of that is there's a bit of accumulation in it. And so we have 10% of our portfolio in closed-end funds that are very high returning, accumulation, no income paid, completely illiquid, for 2-3 years before you get your money back. And so it allows us to kind of pick, for people who want income with some growth, we have that. For people who just want income, we structure portfolios that generate income with no accumulation in the way that we allocate across our portfolio. right? So, which is not an easy thing to do without getting the structures in place.
Understood. And Hagai, when you are looking from a whole of portfolio perspective, what are the implementation challenges that you struggle with, that you think are worth paying for?
Yeah, I'd say liquidity probably is the number one consideration or the number one pain point for most private investors. I think naturally most good managers would have some sort of closed-end vehicle out there through which they raise and deploy capital, and often getting exposure to that vehicle implies high minimum amounts to obtain sufficient diversification. And such closed-end vehicle would have anywhere between, I want to say, 15 and maybe 30 loans in it, right? So to obtain sufficient diversification, an investor needs to deploy several of those, and preferably over time as well to obtain that vintage diversification as well. So just building that kind of exposure can take like a good 5 years, right, for a private investor. So I'd say investors that have a portfolio large enough to put together this kind of a strategy. And clearly the patience and the rigor to construct such exposure, we typically get, we would support them by putting together our best idea when it comes to private debt, private credit managers, and put together such strategy. I'd say, there are some solutions out there that provide almost instant exposure to such set of managers. So I'd say vintage diversification and manager diversification clearly. The second thing is currency hedging. So again, investing in private equity or equities just generally, right? You expect a significant upside, right? So short and medium term currency fluctuations are arguably less of an issue in the context of the expected total return from a strategy, right? When it comes to private credit, if investors are expecting, let's call it high single digit or low double digit type returns, a currency move can wipe out 50% or 2/3 of that kind of return profile over a quarter, right? So again, in the context of what we're trying to achieve, not hedging out this kind of risk is perhaps not suboptimal, right? So I'd say currency hedging is actually quite important from both a client experience and fundamentally, I think, when investing in global private debt, and that's always an area of challenge. So there are less products out there that actually do it, and the main reason is because you kind of have to run a program of FX forwards on swaps that are backed by a portfolio of illiquid assets. So it's only top tier managers are actually being able to position themselves in securing some sort of a credit line or a currency hedging facility from a reputable bank to do that. And it's much more challenging to do on a client level. Clients don't usually like running FX hedging strategies on their personal account. There are all sorts of applications to that as well. So I'd say, again, vintage diversification, currency hedging, manager diversification, and probably just the operational burden of capital calls and distributions. Again, could some investors find it more challenging than others.
That makes sense. Thank you. That was very comprehensive. It is 1 minute to go, so we don't have time for more questions, even though I've still got a bunch, and there are other questions that have come through on the chat. I guess my key takeaways from this conversation are that a premium does exist, whether it's an illiquidity premium or a risk premium. There is a premium for private markets. Private allocations do enhance returns. Manager selection matters. Diversification matters, and in many respects, it's hard to do yourself. So make sure that you do deal with it with a professional to help you with the implementation. Toby, I'll hand over to you for the close.
Thank you very much, Adam, and to Nehemiah, Fred, and Hagai. Thank you so much for your time in taking us through what is really quite a complex part of the portfolio management problem. As Adam said, this is really one of those don't try this at home issues. So thank you very much for joining us, all of you today who've been present on this webinar. Just a quick reminder that tomorrow we'll be drawing this to a conclusion by talking with Graham Bibby and Rebecca Jakes of Mercers, who like Hagai are faced with the challenge in their daily jobs of thinking about managers, thinking about strategies, thinking about the implementation issues, and we'll be looking at portfolio management considerations outside the listed markets. So thank you for joining us today, and we'll look forward to you joining us again tomorrow. Thanks, Adam. Thanks, Nehemiah. Thanks, Fred.
Thank you.
Thank you very much.